Okay, so you found the perfect house to purchase, but the only problem is you need to sell your existing house, and the seller of the house you really want doesn't want to wait. What are you going to do? Hi, this is Todd Baker, your certified mortgage planner. Please subscribe to my channel below and hit like if you like this video. If you're getting this by social media or email, my website for all these videos is yourcertifiedmortgageplanner.com. So what you need to do is do a bridge loan. And for many of you that are in this situation, if you get introduced to the concept of the bridge loan, I want to explain what it is and how a bridge loan strategy actually works, because very few people can actually pull the bridge loan strategy off. A traditional bridge loan is a loan that is short term, maybe 3 months to 6 months. Usually it's 6 months with a balloon payment, meaning it's due at the end of 6 months. It is a loan that you use to buy the new property you like, but it has high interest rate, high closing costs, and high points. So the problem is you get in a situation where you've borrowed money to buy the new home with a balloon payment that's going to be due in 6 months. So if something happens to delay sale of your house, you've got that to deal with. And when you do sell your house, you have to refinance the bridge loan, and that's the second set of closing costs. And what it normally adds is $10,000 to $12,000. So whenever I see someone look at a bridge loan proposal as a consumer, you know right away this isn't a good way to do it, but there's a better way. Okay, so there's a few different options. Option number one is a home equity line of credit. So what we do is this. I take your existing home. On a home equity line of credit, you can borrow up to 80% of the value, just like on a cash out refinance. Let me give you a quick example so you can understand. So on a $100,000 value, so your house is worth $100,000, you can borrow up to 80. Let's say you owe 50. That means you can borrow an additional 30,000 on a home equity line of credit. Here's the advantage. I have partner banks that do these, even if your home is listed or going to be listed. Let me tell you what happens. You go to Wells Fargo or any big bank. I bank at Wells, so I'm not criticizing big banks, but 99.9% of all banks that you will go to, and credit unions, by the way, for a home equity line of credit, when they find out your house is listed, they will say you do not qualify. However, I have resources that will do these with really great home equity lines of credit, whether your house is listed or not. So that's an important point. Number two, we can do it with no appraisal up to the tax assessed value. And if we think it's worth more, you can pay for an appraisal. But that's the only cost of getting the money. Then we take that money, and that's the down payment. I get a regular residential mortgage for you using the home equity line as the down payment. So when your existing house sells, you take those net proceeds, you can either invest them, use them to pay down debt, or you can even use them to make a lump sum payment on the mortgage on the new house and lower the payment or just lower the term of the loan. So there's lots of ways you can do. They're all good. You do have to be able to qualify with 2 housing payments. Okay. Now the other strategy is, let's say the home equity line of credit doesn't get us enough money to create the kind of loan and payment we want on the existing home. Then what we do is I do a first and second combo on the purchase, meaning on the purchase of the new home, I structure it with a first mortgage and a second mortgage and a very small down payment. And then when we sell this existing home, we use the proceeds to pay off the second mortgage. And voila, you've just got a perfect loan like you wanted. And I know how to structure it to optimize the interest rate and pricing on those. Now, where do you get the money for either of these strategies if you don't have a HELOC or if it's very small? Couple sources. Number one, obviously cash on hand. But if we're having this conversation, you probably don't have enough cash on hand. Number two, it could be a gift from a family member. So if you have a family member that's liquid and has some liquidity, and they understand that they'll be repaid short term on the sale of your house, that's one great source of getting funds. The other one, because you might not want to bother your family, is a 401k loan. So let me explain that real quick. A 401k allows for you to borrow up to 50% of the value, up to $50,000. You need to check with your plan, because that's the IRS regulation and what Congress set forth and what you can and can't do with a 401k. But when I say check your plan, some only allow for one loan. You might have an existing loan. You got to look into that. But the bottom line is it's a great place to get money, because we can grab those funds. You pay them back through your paycheck at a very small amount. We use them for the down payment on the existing home. And then when we sell our current home, or excuse me, the down payment on the new home, right? Then when you sell your existing home, you pay back your 401k. So there's a lot of ways to do a bridge strategy, but you really need to be working with somebody that knows how to put it together, particularly debt ratio, because debt ratio usually becomes the issue, and you need someone that understands, and that's what I do. It's one of my specialties, is the bridge loan strategy. So for help with this, please feel comfortable reaching out to me, and I will gladly assist you. Thanks so much. Have a wonderful day, and don't forget, subscribe and like the video, or if it's on email or social media, go to yourcertifiedmortgageplanner.com and like and subscribe there. Thanks so much, and have a wonderful day.